Hello and welcome. This is the second video in a mini-series on accounting for options. In this video, we will continue exploring journal entries related to purchasing and selling options. In this video, I will assume you know what an option is, specifically what a put option is, as well as what the components of an option's price are. If you're not familiar with these terms, I recommend you watch the first video in this series. I'll include a link in the description below. Also, check out Investopedia. It has a nice explanation of what the various terms used in options are. I'll put a link in the description below for that as well. In this video, we're going to build off the call option example where Coyote Inc. exercised the call option to buy 1,000 shares of Acme Rockets Inc. stock. So for this example, Coyote Inc. owns 1,000 shares of Acme Rocket stock with a basis of $100,800. After buying the stock, Coyote is worried that an upcoming rocket test may go horribly wrong and cause the stock price to fall. To protect its investment, Coyote buys a put option as a hedge against the stock price going down. Specifically, Coyote purchases 10 put option contracts for Acme Rocket stock with an expiration date of January 31st and a strike price of $117. Acme Rocket stock is trading for $117 per share on October 31st, so the put option is at the money. In other words, the intrinsic value of the put option is zero. On December 31st, Acme Rocket share price has fallen to $112, and the price of the put option is $5.50 per contract. We got this information from looking at an options chain for Acme Rockets. On January 29th, Acme Rockets had a disastrous rocket test, causing the share price to drop. On January 30th, Acme Rocket share price is $75, and the price for Coyote's put options is $42.05 per contract, as listed on an exchange. When you see an options price in an option chain, the price is per share, and the contract is for 100 shares. Therefore, the actual cost of the option contract is 100 times the amount shown in the options chain. In this example, that means that a single contract is $105, and since Coyote bought 10 contracts, the total price is $1,050. Since an option is a financial asset, to record the purchase, we simply debit the put options account for $1,050 and credit the cash account for $1,050. To adjust the value, we look at the price from an exchange and see that the per contract price is $5.50. Since Coyote owns 10 contracts, we know that the value of Coyote's position is $5.50 per share times the 100 shares times the 10 contracts, or $5,550. We know Coyote paid $1,050 for the options, so we need to increase the value of Coyote's position by $4,450. To increase the value, we debit the put option account for $4,450, and we credit the unrealized holding gain or loss income account for $4,450. In this example, we didn't have to calculate the intrinsic or time values like we did in the last example. The price listed in the market quotation wraps the intrinsic value and time values together. Because we know the share price is $112 and our strike price is $117, we know the intrinsic value is $5. Thus, the time value has to be the 50 cents. We don't really care at this point, but we can determine the numbers if we want to. Even though the price has fallen due to the rocket failure, Coyote still has faith in Acme Rockets and decides it wants to keep its 1,000 shares and sell its 10 put option contracts. The price for the put options listed on the exchange is $42.05. To adjust the value, we determine that the value of the put options is $42,050. Since we previously adjusted the value to $5,500, we need to debit the put options account by $36,550 and credit the unrealized holding gains or loss income account by $36,550. A T account confirms that our put options have a debit balance of $42,050. To record the sale, we credit cash for $42,050 and zero out the put option account by debiting it for $42,500 or $42,050. To determine our gain, we can look at the effect of each transaction on the value. The increase in the value shown on December 31st and January 30th shows that the total gain is $41,000. The T account for the unrealized holding gain or loss income account will show the same result. And again, this makes sense since the difference between the contract's value of $42,050 and what Coyote paid for the options, $1,050, is $41,000. To record the gain, we transfer the unrealized gain by debiting the unrealized holding gain or loss income account and crediting the gain on sale of investments account by $41,000. And that's it. We have recorded the various entries for purchasing and selling put options as well as adjusting their values. We can post these entries to the general ledger and we're done. Now let's look at a second example where Coyote thinks the stock will not recover from the rocket failure and decides to exercise the put option and close its position in Acme Rockets. Recall from the previous video in the series that Coyote owns 1,000 shares of Acme Rockets with a basis of $100,800. On January 30th, when Coyote exercises the put option, the price of Acme shares is $75, and Coyote's put option allows it to sell its 1,000 shares for $117,000. The previous journal entries for purchasing the put option and adjusting their values on December 31st are the same. The journal entry for increasing the value prior to exercising the option is also the same. We debit the put option account for $36,550 and credit the unrealized holding gain or loss income account by $36,550. Again, we calculate the carrying value of the put option using a T account and see that the entries for purchasing and the various adjustments give us a carrying value of $42,050, which is 1,000 times the price shown in the options chain. For the unrealized gain, we again use a T account and see that the balance for the unrealized holding gain or loss income account is $41,000. To record the stock sale, we credit cash for $117,000. That is the $117 strike price for the 1,000 shares. We zero out the balance for the Acme shares by crediting the account by the basis or the $100,800. We close out the put option account by crediting it for $42,050. We also zero out the unrealized holding gain or loss income account by debiting it for $41,000. Finally, we credit gain on the sale of investments by $15,150 so that our debits equal credits. As a sanity check, we can calculate the gain by subtracting the basis in the stock and the price we paid for the put option from the proceeds for the sale. In other words, the basis of $100,800 for the stock and the $1,050 paid for the option subtracted from the $117,000 proceeds results in a gain of $15,150. In future videos, I'll go over the journal entries for shorting both call and put options. I'll also present the results in quarterly financial statements. Please like and subscribe so you don't miss out. Thanks for watching.